Right now, as the market is live, Lithium Americas Corp, ticker LAC, is trading at $5.365. It is down sharply, falling $0.52 or a very significant 8.91% in just the first hour of trading. The day's range has already been set between $5.44 and a low of $5.285. And we are seeing heavy volume, with over 1.5 million shares changing hands this early. This isn't a quiet drift lower. This is a very aggressive move south. And here is the immediate insight that matters. This stock is falling apart today, despite just recently securing the first major drawdown from its massive $2.2 billion conditional loan from the U.S. Department of Energy. That news, which should be a massive de-risking event, is being completely ignored by the market. The expectation was that government backing would put a floor under this stock. The reality, as we are seeing in real time, is that the market is far more concerned about something else, namely the brutal, ongoing weakness in lithium prices, the project's staggering capital requirements, and the very real threat of more dilution. Let's establish the common ground, the story everyone believes they know about LAC. For the past 2 years, the narrative has been simple. Electric vehicles are the future, Tesla stock has shown what's possible, and the U.S. needs its own supply of lithium to break its dependence on China. Lithium Americas, with its 100% ownership of the Thacker Pass project in Nevada, is positioned as the single most important domestic lithium source in the entire country. It's a picks and shovels play on the entire EV supply chain. General Motors is a partner and customer. The Department of Energy is a financial backer. On paper, it looks like a can't-miss opportunity. Many investors, particularly those doing some self-investing on platforms like the Robinhood app or SoFi Invest, bought into this story expecting a smooth ride up as Thacker Pass moved from plan to production. But today, the market is challenging that belief. It's forcing a rethink. The reality is that Thacker Pass is not a high-growth, asset-light software business like NVIDIA stock, which can scale with relatively little friction. It is a mine. It is a massive, complex, multi-decade-long, capital-intensive industrial project. It requires digging huge amounts of earth, processing it in a complex chemical plant, and dealing with immense logistical and environmental hurdles. The DOE loan is not a gift. It's debt that has to be serviced and repaid. And that loan, while huge, still doesn't cover the full cost. The company has been and will continue to be selling shares into the market to raise the rest of the capital it needs. That means dilution. Every new share sold makes your existing shares worth a little bit less. This is the reality that is hitting the stock today. Let's analyze this recent movement more closely. A drop of this magnitude, nearly 9% on heavy volume, suggests that this isn't just retail investors on the SoFi trading platform getting cold feet. This has the hallmarks of institutional repositioning. Portfolio managers at large funds, perhaps using Fidelity Investments or managing a Fidelity brokerage account, are looking at their spreadsheets. They are updating their discounted cash flow models with two new, very negative inputs: a lower long-term forecast for lithium prices and a higher share count from future dilution. When those models spit out a new lower valuation, they don't wait around. They sell. They hit the button on their Interactive Brokers trading platform and move on. This is what separates professional analysis from the retail story. The story is about the future. The professional calculation is about the present value of that future. And right now, that value is shrinking. The macro pressure here cannot be overstated. The entire lithium sector has been under severe pressure. After the massive price spike in 2022, lithium carbonate prices collapsed in 2023 and have failed to mount a serious recovery. This has taken down the entire sector, from the world's largest producer, Albemarle, right down to development stage companies like LAC. The expectation was that demand from the EV sector would keep prices high forever. The reality is that supply, particularly from new projects and expansions, came online faster than expected, while EV demand growth, while still strong, hit some speed bumps. This created a glut, and prices cratered. For a company like LAC, which has no revenue and won't for years, its entire valuation is based on the future price of lithium. If that future price looks lower, the stock is worth less. It's that simple. So what does LAC actually do? Following its corporate separation, where it spun off its Argentine assets into a new company, Lithium Americas Corp is now a pure-play U.S. lithium development company. Its sole focus is Thacker Pass. This project is, to be fair, a world-class asset. It is a sedimentary clay deposit, which requires a different extraction process than the brine or hard rock mines seen elsewhere. The company has spent years developing the processing technology and just recently began construction on its hydrometallurgical processing plant. The plan is to produce battery-grade lithium carbonate in 2 phases, eventually becoming a major supplier to the North American EV battery supply chain. It's a project of national significance, which is precisely why it got the government's attention. But it remains a project. It is not a business. A business has revenue, it has margins, it has cash flow. LAC has cash burn. It is spending hundreds of millions of dollars a quarter to build its future, and it is entirely reliant on capital markets and its DOE loan to fund that construction. This brings us to the future outlook and the continued tension between what is expected and what is real. The bull case, the expectation, is that the management team executes flawlessly. Construction at Thacker Pass continues on schedule and on budget. The first phase of production begins as planned, and the company starts generating revenue. In this world, the lithium market will have tightened by then, prices will have recovered, and LAC will be one of the few large-scale domestic producers selling every bit of lithium it can make at a high profit. In this world, the stock, even from here, would be a multi-bagger. Investors holding it in a Fidelity IRA or even a diversified account like Schwab Intelligent Portfolios would be handsomely rewarded for their patience. Now, for the reality of the risks. First, there is execution risk. Mining projects are notorious for cost overruns and delays. Thacker Pass is using a new, complex process for clay-based lithium. Any hiccup in the plant's commissioning could set the timeline back by months and cost hundreds of millions of dollars. Second, the financing risk is still very real. The DOE loan is conditional. The company must meet certain milestones. And as mentioned, it doesn't cover everything. The company will likely have to sell more shares. If the stock price is low, like it is today, they have to sell more shares to raise the same amount of capital, creating a vicious cycle of dilution. Third, there is the commodity price risk. If lithium prices stay low, the entire economic model for Thacker Pass gets weaker. The profit margins won't be as high, and the payback on this multi-billion-dollar investment will take longer. This is a real threat. And finally, there is lingering legal and regulatory risk. While the project has cleared its major environmental hurdles, it's still facing opposition, and any future court order could create new headaches. This is not a stock for the faint of heart. This is not a stock you buy in your Fidelity mobile app after reading a single headline. This is a high-stakes bet on project execution and commodity prices. It's the kind of investment that separates a simple online investment from a deeply researched position. The people who buy this in their individual brokerage account need to understand they are not buying a tech stock like Apple stock, which prints cash every quarter. They are, in effect, becoming a venture capitalist for a massive long-term industrial project. To that point, I want to hear from you. Comment below with what you think the most significant risk for LAC is. Is it the price of lithium, or is it the risk of construction delays at Thacker Pass? Let me know what you're tracking. To summarize, the story of Lithium Americas is a perfect example of expectation versus reality. The expectation is a clean, simple, and patriotic investment in the U.S. electric vehicle supply chain, backed by the government. The reality is that LAC is a pre-revenue, capital-intensive mining developer completely exposed to the volatility of a single commodity. The plunge we are seeing today, despite the good news of the DOE loan drawdown, is the market's way of reminding everyone of this reality. The market is pricing in the risk, the dilution, and the long, difficult road ahead before a single ton of lithium is sold. The dream is still alive, but today, reality is winning. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions.